Well, now in this class, we will learn about different kind of stocks, or we can say that the classification of stocks. Uh, we saw one approach where we understood whether we should go to SIP model or lump sum model in the previous video. And in this video, we will explore about different classification of stock so that again you can develop one approach based on the information which I'm going to provide you. So the very first classification which we do is on the stock classes or the ownership level stocks. So common stocks are, when I show you every time NSE website, I always show you these stocks which are said to be common stocks. So common stocks gives you a benefit of voting rights. The moment you buy one stock of Tata Steel, you also become shareholders and you gain a voting rights. Obviously, if you buy one, you got just one fraction of the total voting rights, which may not be able to do much, in AGMs. But you get a voting right. So from retail perspective, it might not make much difference, but a normal shareholder will get a voting rights. He will get dividend also, and moreover, in longer run, if you see, you are actual partner of the company. With the growth of the company, you will be equally benefited. There are other category of stocks also which these companies issues, and they are called preferred stocks. In preferred stock, you don't get voting rights. So these preferred stocks, are generally using preferred stock company raise money through the private placement. Though these stocks are also listed on NSE under P1 category. So if you go and Google, I have already opened this for you. So these are the sum of preferred stocks which you can see on NSE website. Right now you can see in last 5 years a total of 361 preferred stocks have been listed there. However, in this course we will focus on mainly common stocks, and one another kind of a stock is also called DVR stocks. Preferred stock valuation, preferred stock transaction is something which needs to be done differently, and there are very limited choices you have. So that's why I'm not going to cover in coming chapters about the valuation of the preferred stock and other stuff, because in preferred stocks you are promised one fixed dividend every year, and you are given that dividend. You don't get voting rights, you are not having that fractional ownership rights kind of a common stocks, so they get priced differently. You enjoy a dividend there, higher dividend than the common stocks. So this is what is called the preferred stock. Dividend DVRs are called DVRs are, so some people confused DVR between preferred stocks. Preferred stocks people don't have any kind of voting rights. However, in DVR stocks you get different voting rights. Till now, we had heard that generally DVR stocks get lesser dividend, higher dividend, but lesser voting rights. So differential voting rights means you don't get the equal voting rights like a common share. So every time a company think that they need to bring DVR because they want to raise the money through shares but don't want to dilute the right, they generally bring DVR shares. But there is one exceptions now. Before explaining you the exception, let me show you one company. So if you have heard, most of you would have heard about Tata Motors. So if you see, Tata Motor is having a DVR share. Tata Motor DVR. Price is at 73.5 rupees. Then you have a normal share for this also. Tata Motor normal. Price is 176. Ideally, the price should be same, but DVR is at discount right now. So this keep on happening between normal and DVR shares. In DVR shares, you used to have only lesser voting rights. So the way it was constructed, that promoters can define that if you buy 10 DVR shares, you will get voting rights equal to one normal share. This was always the case till some time back. I don't remember the dates exactly, but around a year back, now we have new rules where companies can issue DVRs with more voting rights also. So this is a new change. This has happened because of the new age startup funding, where some people want to give money. They don't want to take all of shares, but they at least want their say into the company. So even after having lesser number of shares, they can have a higher say, and they can negotiate it with the founders of the company. So the new rule has also come when a DVR shareholder will have more voting rights. Otherwise, globally, in general, DVRs are issued when companies don't want to dilute enough voting rights and still want to raise money. Again, in DVR shares, why would you go for DVR if you are not given the equal amount of voting rights? You will go because again DVR give little better dividend than the common shares. So one classification is stock classes. So some people may simply go and start finding DVR shares after knowing this information. And they think that anyway I'm going to buy 50 stocks, I'm not gonna exercise my voting rights ever. Why do go and buy DVR shares? I'll enjoy better dividend. So this could be one of the way also, though in our country till now we don't have many DVRs, and investing into preferred shares are not that easy. But now that I'm taking this course, I assume that you people will use this information in future also. So I have included this classification. Second classification is done on market capitalization. Very simple. Companies who are large are called large cap, large in terms of market capitalization. So most of these companies in Nifty 50 will be called large cap companies. They are stable companies. They have good liquidity in the market. They have good cash, good diversified business. So companies with the market capitalization of anything like what you can say 10,000 crore, 20,000 crore, 50,000 crore, 1 lakh crore, anything above 5,000 crore is can be put into large cap also, right? Though there is a, I mean, there's no fixed rule how would you define a market capitalization, how would you define a company a large cap? But yeah, in general term, any company higher than 10,000 crore can be kept into large cap category. Some people may say that no, I want to keep 7,000 crore company into large cap. I won't debate with him. Okay, he may be right there. 10,000 crore plus company is a large cap company. Now, when I say small cap company, any company with, let's say, below 200 crore market capitalization can be called a small cap company. And everyone else, so I can say that anything between 200 crore to 10,000 crore will be called a mid cap company. Well, there is obviously overlaps keep on happening between mid cap and the small cap. There is no fixed definition, but idea here is to understand that large cap companies nature is different from small cap companies. Your capital protection chances will be more high in large cap. But let's say you got a company of 5 lakh crore. Is it possible that a 5 lakh crore company can become 50 lakh crore company in 5 years? The answer is, is like very rare chances that a company which is a 5 lakh crore company will multiply by 10 times in 5 years, because it has become already very very large. So many people are working, so many processes are already there, and they have become large because they have already catered the need of largest size of the market already. That's why they have become big. Now they will not start overselling the market size. So let's take an example. One company, Tata Steel has become, or let's say TCS has become 7 lakh crore company. Okay. Now it has become 7 lakh crore company because it has served the market size of IT industry by 30-35%. Obviously, there are other market players, they are also serving. Now, TCS cannot go and overserve the market. It is doing 35%, it may go to 100%. It cannot go and start serving at 300%, right? I mean, they have to serve as per the demand, and they are already market leader. So there will be a very, very high chance that market will grow at a certain phase, and they will also grow at a certain rate, right? So large cap companies capital appreciation will be low. They will give you a consistent return, 15%, 16%, 20% in some cases also, 25%, but not like going and getting doubled every year or every 2 years. However, if you go to a small company, can a 100 crore company become a 1,000 crore company? Yes. They still have to go and capture a good market size, and they can do it. So, but a small company also have a very high chance that it may get into troubles very easily, unlike a large cap companies which have a lot of backup, lot of brand building already done, a lot of learning which has already happened in the large cap company. In a small cap company you get bigger risk. So, in any slight change in the market or industry can impact a small cap company. A small cap company can be, muscle twisting can be done by a large cap company. But again, so this is a very personal choice based on the risk appetite of a person, whether he want to stay into small cap, mid cap, and large cap companies. These are the classification based on the market capitalization, and it's more to do with, when it comes to the practice, it's more to do with the risk taking ability of one person. I would suggest, if I have to suggest something, a person at age of 50 should stay into a large cap company. A person at age of 30, 25 started investing into stocks, want to be little, on the side of where they want to take chances. They can go research well about small cap and mid cap companies, and they can invest into that also. Then you have classification based on dividend payment. Okay, we heard a lot about power of compounding in last few chapters. So how does power of compounding work? Power of compounding work in this fashion, that you have, let's say, 100 rupees, you made a profit of 20 rupees next year. You reinvested that, and you have now 120 rupees, again made a profit of 20%, which makes your capital 144. Now you have 144 rupees here. You again made a profit of 22%, which comes down to 28 rupees or something. 144 into 8, 152, 172.2 or something like this will come. Now what you can see that this is increasing at compounding rate. Now, there could be another situation, and the situation is you have 100 rupees, you made a profit of 20 rupees, and you spent this 20 rupees, right? Then again, you are left with 100 rupees. Next year, again, you spent, or let's say, took out the profit and kept it aside again, and then again, in third year, you have 100 rupees and you kept this profit aside, right? So in 3 years you can keep this profit aside, and or spent it, you will have 60 rupees. At the third year your total sum will be 160 rupees. However, if you keep reinvesting, your total sum will be 172 rupees. So what you can see here is like, in power of stock market work on the philosophy of power of compounding. When they earn money they reinvest, and that's how they become larger companies over a certain period of time. But there is a situation. A situation is where a company has already become big. They don't know what to do with the retained profit. So they go and distribute that dividend among the investors, right? So they are called dividend stocks. And growth stocks are those stocks who keep on reinvesting the money into the company, right? So it is a matter of choice for a company management whether how much money they want to reinvest and how much money they want to give as a dividend. Many of the time it's choice, and sometimes it's a necessity. I mean, you don't have a choice. Your business is really growing fast. You need more and more money. You may choose to not give dividend, and investors will be still very happy because they know that their business is growing, their stock prices are going. On the other side, there are people who may think, okay, I want to invest into market with the one expectation that I get good dividend every year. So I stay invested in the company as well and take some money home as well. In fact, on Quora, since a lot of people have joined this course through Quora, I have also shared you link one of the list I recently published on the dividend stocks. So stock classification is also done on the dividend payment method, and it is done as per this explanation which I told you, that sometimes it's need, sometimes it's necessity, and sometimes it's a matter of choice for the management. And these choices happens because of in which sector these companies are offering their services or making the product, at what stage they are. So you need to understand this for sure. Before investing, you have to go and see whether whether these companies are aligned with your own expectation in terms of dividend or growth, multiple growth, right? Okay, well, this is a very debatable classification, the valuation based. So the question is very, so that here it is something like it is get taught, so I'm teaching you people. Otherwise, it is completely based on the intrinsic valuation. For me or for many other people, or even whom I consider the god of investing, he teach value investing also, and he has written a great book on valuation, Mr. Damodran. He also says that though I'm teaching you intrinsic valuation how to find, but it's almost impossible to find the right intrinsic value. Right intrinsic value means share prices is something else on the basis of share pricing, because share prices are there in the expectation of future income. The real value of the company could be something else, which is called the intrinsic value. So you calculate that valuation. Then there is something called book value also, which I explained previously. So this is a very debatable classification. Some person may find a company undervalued, and then other person can find it overvalued, for sure. I mean, some people may say that we need to do a classification based on valuation, and we should categorically say that this stock is overvalued or undervalued. Well, if this classification would have been so simple, why would anybody go and buy the overvalued? They will all go and buy undervalued. But yes, this kind of classification is also there in theory. You can have your own theory around the classification based on the valuation. For example, we can probably see one of the company again as example, that Tata Motors, a large company, big company. So you can see Tata Motor book value is 169 rupees. Current price is 174, right? Some people may say that okay, it is undervalued. The price of this company should have been actually 350 rupees or 240 rupees, but it is right now 174 rupees, and that's why it is undervalued. One can certainly say for Tata Motor DVR that okay, we got a company whose normal share is trading at 175 and DVR share is trading at 72, and I don't find a reason why you should trade at 72. I can 100% tell that Tata Motor DVR is a undervalued stock. Well, this is an example, and as I say, it is a very debatable topic on the valuation based classification. For one person, one stock may be overvalued, and that's why he's not buying it, and the same stock could be undervalued for 1%, he can go and buy it. Since calculating intrinsic valuation also is something very difficult and that differs from person to person, that's why I'm putting this as a debatable category. But yes, the classification of stocks also get done on the valuation, where we say that one stock is overvalued and we say that another stock is undervalued. Then you have risk based. In risk based, what happens that if market is up by 1%, you know, so let's keep it like this: market Nifty is up by 1%, and stock is up by 1.2%. Market is down by 1%, and the stock is also down by 1.2%. If it would have been something like this, that market is up by 1% and the stock is also up by 1%, and market is down by 1% and the stock is also down by 1%, we would have very easily said that beta of the stock is 1. Yes, beta defines the volatility. A stock could be highly volatile, a stock could be less volatile, right? Volatile means it goes quite high, then it comes down very heavily also. So there is a classification based on beta. So a company which is less volatile is called a blue chip company, and a company with which is more volatile is called a high beta company. So generally a company which is spread across many sectors like L&T, it's a blue chip. They're into so many businesses. If market if goes up, it also goes up. When market comes down, it also comes down, but it don't go up like on one day it is up by 4%, another day it is down by 5%. Reliance Industries, again, it is a blue chip company. It will not go like crazy and come down like crazy. However, you would see many stocks which is up by 3% on one day and down by 2.5% another day. They are called high beta stocks. So some people, especially for traders, they enjoy trading into high beta stocks because they get a lot of volatility. For long-term investors, they generally go and choose blue chip stocks. They understand that stability is something which is very important because they are a investor. So risk-based classification is also there. Then you have price trend or economy trend, classification. So to explain you, let me give you some example. You have food and beverage industry. See, doesn't matter economy is going into which cycle, you will go and buy food because without food you cannot live, right? It's a necessity. So every company which comes into those sectors which is serving the very basic necessities of life, they will be called quite a defensive stocks. Okay, like pharma companies, ITC, HUL, they will be called defensive stocks irrespective of the economic cycle or the price cycle in the industry. They will stay there, and don't go crazily after the performance of economy. However, there are other sectors like auto sector. Let's say you didn't get good bonus this year. Why? Because company didn't perform well. Why didn't perform well? Company didn't perform well because economy is not going through the right phase. Okay, if you didn't get good bonus and you were planning to buy a car because you were supposed to get a good bonus, you will postpone your plan of buying the car. So some sectors are there which is not catering the very basic necessity of a person, you know or a customer. They are called cyclical stocks. So there could be a situation also like country itself is not doing well, and to invest into infrastructure they don't have enough money, and for infrastructure development steel is required, so the consumption of steel will go down. Similarly, the way the consumption of auto was going down. So these kind of sectors will be put together into cyclical category. Defensive category will be not impacted affected by the performance of economy, and cyclical stock will be greatly affected and impacted by the cycle of the economy. So one person has to be very clear which kind of a stock he is buying, cyclical and defensive. Then only with news, if he is also following the news, I mean, we all of us keep hearing news about economy, right? So you get basically well placed if you know whether you are into cyclicals or defensive. Accordingly you track. So knowing this factor also is very important, that when you are choosing a way to invest, whether you want to be on the cyclical side or the defensive side or a mix of it. Both have its own advantages and disadvantages also. Cyclical stock may perform really well also when economy is performing well. right? And defensive stock has a benefit that even if economy is not doing well, it will still hold. Well, this was the classification of stocks, and now we will move in the next segment where we will understand about how what are the different avenues through which you can. That will be a very quick class because most of those things we have already covered. But again, we will jump it in the next video only. Thank you.